If you've ever tried timing the stock market and failed miserably, here's the good news. Most people do. But there's one strategy that quietly beats emotional investors, chaotic markets, and even many professionals. It's called dollar cost averaging, and it might be the simplest path to long-term wealth you'll ever find. Dollar cost averaging, or DCA, is an investing strategy where you put in a fixed amount of money at regular intervals, regardless of whether the market is up or down. Instead of guessing the perfect moment to buy, you buy consistently. Over time, this smooths out the price you pay and reduces the emotional pressure that causes people to make bad decisions. The point of DCA isn't to beat the market with timing. It's to make sure you're always invested, always building, and never depending on luck. It turns investing from a stressful guessing game into a predictable habit. Actionable steps. Pick a fixed amount to invest weekly or monthly. Choose one or two reliable index funds or ETFs. Automate the contributions so emotions don't interfere. Most investors believe they can wait for a crash, buy at the bottom and sell at the top. In reality, market bottoms only become obvious in hindsight. Even professionals with decades of experience fail to predict them consistently. Dollar cost averaging removes that risk because you invest across all conditions. You buy when prices are high, you buy when prices are low, and those low price purchases pull down your long-term average cost. Actionable steps. Stop waiting for the perfect moment to start investing. Begin with small automatic contributions, even if markets feel unstable. Track how your average cost per share drops over time. With DCA, every market dip becomes an opportunity. When prices fall, your fixed contribution buys more shares. When prices rise, you still buy, but fewer shares. Over years, this creates a powerful compounding effect because you accumulate more units when they're cheap and hold them as they appreciate. This is why long-term investors love DCA. You never panic during dips and you never feel FOMO during rallies. You simply follow the plan and let the math work for you. Set your contribution schedule for at least 12 months. Reinvest all dividends automatically. Review your progress once per quarter, not daily. Lump sum investing means you drop all your money into the market at once. Statistically, lump sum often performs better because markets tend to rise over time. But emotionally, most people cannot handle the fear of losing money immediately after a big deposit. Dollar cost averaging wins for beginners because it matches human psychology. It reduces regret, lowers emotional risk, and helps you stay invested longer, which matters more than chasing the mathematically perfect strategy. Actionable steps. If you receive a large amount of money, consider spreading it over 6 to 12 months. For monthly income, stick to a recurring DCA plan. Choose consistency over perfection. Dollar cost averaging works best with long-term diversified assets. The most common choices are total market index funds, S&P 500 ETFs, or broad international funds. These assets naturally fluctuate enough for DCA to provide benefits and historically trend upward over long periods. You can also use DCA for retirement accounts, real estate crowdfunding platforms, and even Bitcoin or other digital assets. The key is consistency over time, not predicting short-term price action. Actionable steps. Start with one low-cost index fund. Keep fees below 0.1% whenever possible. Avoid picking individual stocks until you have a stable DCA base. The right number depends on your income, expenses, and financial goals. Instead of chasing an ideal figure, start with an amount you can invest without stress. For many beginners, even $50 to $200 per month is enough to build the habit and experience results. The important part is to make it automatic. When the transfer happens without your involvement, the strategy becomes effortless, and you avoid the temptation to skip months during emotional market moments. Actionable steps. Begin with 5 to 15% of your income. If cash is tight, start with a minimal fixed amount and increase later. Review your contributions every 6 months and scale up when possible. The biggest mistake is stopping the plan when the market drops. This defeats the entire purpose of dollar cost averaging because the best long-term gains come from buying during downturns. Another mistake is constantly switching funds, chasing trends, or reacting emotionally to volatility. Your DCA plan only works if you commit to it through all market conditions. The consistency is what builds wealth, not perfect timing. Actionable steps. Set rules before you start. How often you invest and what you invest in. Avoid checking your portfolio more than twice a month. Don't pause your contributions unless you have a real financial emergency. If you invest consistently for years, the numbers become life-changing. Even modest monthly contributions can grow into six figures thanks to compounding. DCA creates the habit creates the consistency, and the consistency builds the wealth. Over decades, the strategy becomes nearly unstoppable. You accumulate more during crashes, you stay invested during recoveries, and you remove luck from your financial future. Actionable steps. Think in decades, not months. Resist changing your strategy during extreme market news. Use DCA as the foundation of your long-term wealth plan. Dollar cost averaging isn't exciting. It won't make you rich overnight, but it is one of the most reliable investing strategies for everyday people. It protects you from emotional decision-making, keeps you investing through market cycles, and builds wealth quietly and steadily. The earlier you start, the more powerful the results become. You don't need to predict the future or beat the market. You just need to stay consistent. Actionable steps. Start your first automatic contribution today. Keep the amount manageable and sustainable. Commit to the process for at least one full year.